Oh, now it goes. There you go. Whenever you want to start, and I'll help him.
Okay.
Remember, loud.
Pretend that you just pretend that you're speaking to the person at the back of the room, whether they're there or not.
Yeah.
Absolutely. And you'll be fine. If you want to make sure that way it'll project well. That's what I tell the speakers on
See that little.
our Friday meetings and stuff, same thing. Just.
Well, good morning. My name is Teresa Oliver. I am the accounting and advisory partner with Millennial Bookkeeping and Advisory Services. We are a virtual firm serving small and mid-sized businesses. We handle everything from business formation to tax resolution. And we specialize in businesses on the cusp of a change. So if what you're doing now is no longer working, give me a call. So that's a little bit about who we are and what we do. And I just took this from our website. We handle tax, bookkeeping, and advisory services for individuals as well. We partner with our clients, and so it's not a distracted or detached relationship. We are hands-on with your business. And this is how we do it. Okay, so a lot of small businesses don't understand why they need accounting. They don't understand how it works, and they're like, well, I don't need that, I have money in the bank, right? So this is some of the reasons why you need accounting. To keep accurate record of your business transactions, to manage your expenses, financing, projections, and growth. So you need accounting for your business like you need to balance your personal checkbook, right? How do you know how much money you have? How do you budget that money to pay the things that you need to pay? How do you save that money that you earn to purchase a house or to purchase a car? How do you get there? Personally, it's a smaller accounting, but it's still accounting. So it's smaller money and transactions that you're dealing with, but in a business, it's so much bigger. And so you can't drop the ball on your personal finances and your business finances. I'm a little bit nervous, but when I get to the details, we'll talk more about it. And I'd like to interact, so if you guys have questions or stop me, please do so. Okay. One of the biggest things that I see with business owners is that their chart of accounts is set up incorrectly. And your chart of accounts is basically the list of all of your accounts that you allocate your business transactions to show up on your financial statements, mainly your income statement and balance sheet. So your chart of accounts is going to populate the format in which your income statement, yes ma'am.
What's the chart of accounts?
It's the list of accounts that you use. It's a list of accounts that you use for your business transactions. So it's basically saying that, so you can have expenses, but there's a bunch of subcategories in expenses. So you have mileage expense, you have rent expense, you have salaries and wages. That's what it is. So it categorizes your transactions in an account that says, hey, you spent this much money for this type of transaction in your business.
So not by the company it's with, but by the type of expense?
Right, right, it's categorized by the type of expense. So your income statement is made up of I call it the essay, right, that's how I read it. Your revenue and cost of revenue to get to your gross profit is your introduction, right? This is your topic. Who are you? What do you do? Right? Your expenses is the body. This is how are you using what you have left over after you make the sale to pay for the overhead of your business. And your net profit or loss is your conclusion, right? How well did you do this to get here? So gross profit with the chart of accounts giving you the incorrect impression. Here we have a sample income statement. And so you see here that the gross profit is 99.52%, right? When you look at this income statement, you can see that the total income is about $72,500, right? But the cost is $345.15. That doesn't make any sense. That's saying that you've only spent $345 to make $72,000. If that's true, I need you to teach me how to do that, right? Because that doesn't make sense. But what that does is, if you're reading your financial statements correctly and on a regular basis, it looks like you have 99% of your revenue to cover the overhead of your business. But you actually don't, right? Because this, salaries and wages, that is an expense, and it could be overhead, but it depends on the type of business that you have. If you have a service business, your cost of that sale is paying your employees to provide that service, right? So putting that in your overhead, it messes up your gross profit percentage, right? And it just makes you think that you have more money to spend on overhead, and you actually don't. So now if we move the salaries and expenses, wages and salary, above the line in your introduction, because it says, this is what I offer to the world, this is how much it costs me to do that. So now I have 62% of my sales with which to run the overhead of my business. That's more accurate, right? And I like to see a 70 to 75% gross profit margin, right? Because your expenses is gonna be about 50%, and that just depends on what year you are in your business. And I want your net profit to be at 25% at a minimum. I believe the standard for technology companies is about 27%. That's what Microsoft is doing right now. So now going back here to your expenses and your overhead. Let me see. So we talked about gross profit margin, expenses is the body, and your net profit is your conclusion. I highlighted something here. This is all going into your chart of accounts and making sure that you're building it up correctly so that you're reading your income statement correctly. This bank service charge is a negative line item. How is that possible? Did the bank overpay you? No. We know that the bank is not overpaying us, right? That's incorrect. Something happened in your transaction that was wrong and made this account reflect a negative balance when its normal balance is positive, right? It's supposed to be an expense to you, right? What else? So in your body, and I changed it from cost of goods sold to cost of labor. Changing the name of an account makes a lot of difference. So in your body, in your expenses, you can have sub-accounts. So if you have multiple properties, you can create a top rent account and you can create sub-rent accounts that all rolls up into rent. You have insurance, you can roll, auto insurance, workers' compensation, general liability, and roll it all up. It just makes your statement look a lot better. And then on an overview, you'll be able to see how much you're spending on insurance per month, how much you're spending on rent per month. The body is what we focus on, right? Because your introduction, think of it like this: if you're given a topic to write an essay, you can't change the topic, can you? The only thing you can do is change the body. And from the body, your conclusion will come naturally. We focus on the body of your income statement. What can we do here to get you a better conclusion, right? Once we focus on that and we get that cleaned up, that includes process improvement, internal controls, getting you set up with vendors. A lot of small businesses, they swipe their debit card and their credit card entirely too much, right? When you look at a bank statement for a business, it should not read like your personal bank statement. Meaning it shouldn't be swipes at 7-Eleven and at Winco and at Walmart and Target. It should read like wall company, cabinet makers. It should read all of your vendors, and it should be money coming in and it should be checks going out. That should be the bulk of your bank statement, not just individual transactions. So here in the body, we work that, right? We get you set up with vendor relationships. Office supplies is a standard expense, right? Are you affiliated with an office supplies vendor? Are you getting 30-day terms? That goes into cash flow, right? Are you optimizing your cash flow by using credit terms so that you have more money to run your business today and you can pay tomorrow? That leaves money in your pocket. That leaves the cost of labor or cost of goods sold that you have to use to make a profit, and it increases that cash flow, right? So that's where we focus on. Like I said, the conclusion is a natural occurrence from the intro and the bottom. Okay, I have some ratios and calculations that every small business should look at all the time and should know. One of them is your gross profit margin. We just talked about that. What does it mean? The amount of money you have left to cover your overhead, right? It's your cost of labor. It's your revenue minus your cost of labor. It indicates how successful you are at making a sale for the lowest cost. So the example that we saw, they were really good, right? They used less than 1% to make those sales, which was inaccurate. But if your income statement and your chart of accounts is set up properly, you will have a good idea of how successful you are at making that sale at a low cost. That means that you're building relationships with people so that it's costing you less money. Eventually, over time, your expenses should bottom out within a relevant range. So unless you have extreme growth or an extreme decline, your expenses should bottom out, right? Because you're getting better and better and better at it, right? When we're typing, when we first started typing, we were using one finger. Now we're not even looking at the keyboard and we're just typing. We've gotten better, we're more efficient. That's what your cost of goods or cost of labor should be. And your gross profit margin is an indicator of that, in addition to knowing how much money you have to spend on your overhead. And it's calculated by the revenue minus your cost of goods sold divided by your revenue times 100 to get your percentage. So here, for example, if you have $5 million in revenue, $2 million in cost of goods sold, divided by the $5 million is 60%. So you have 60% to cover your overhead and hopefully have a net profit versus a net loss. In your break even. So does anybody know their break even? Point, quantity, no? So your break even is the point where your sales equal your cost. That means that your net profit is 0. So you're not going under and you're not swimming. You're just there, right? Which is not abnormal for new businesses. They should, that's the goal, is to break even, right? So break even is a multiple step calculation. So you need to know your profit, your revenue, your variable cost, and then you get your break-even quantity. You need your fixed cost, which is the total amount, not the unit cost. And then this is your total variable cost, your unit variable cost, and then you just fill in this number here, quantity sold, so that you can get a break-even point. And it'll become clearer. This is your unit sales price. That's what USP means. So you sell your product for $3 each. And so here on the chart, you'll see that when you put those numbers in, you're gonna come up with your break-even point. And your break-even point is at a quantity of 6,000. So at 6,000, you break even. Your sales equal your cost. And so here you can see this line is your total cost, and the purple or pink line, fuchsia, what color is that? That's your revenue. So when your revenue equals your total cost, you have broke even. This is something that every business needs to implement, and you need to know at all times. Things change. Your fixed cost may change. Your variable cost may change. Everything in accounting is within a relevant range, right? So yes, it may be fixed, but it's within a relevant range. If you tremendously increase or decrease, that is going to change. You need to do your break even again, and you need to see, okay, what is it that I need to do in order to come out straight? And you have your inventory turnover ratio. So for those who carry inventory, QuickBooks, which is one of the primary softwares that I use, uses the LIFO method. LIFO is last in, first out. So that means that the last price that you paid for your inventory is what's going to be recorded on your books as an expense when it goes out the door. So inventory turnover is important because you need to know how often is my inventory turning over, and then with that information, you can say, why do I have so many days between inventory turnover? Why do I have so much inventory? Then again, cash flow. Cash flow is always affected. Are you buying too much inventory? Right? Why do you have so much inventory in stock if it's taking so long to turn over? You've wasted good cash flow that you can use to actually make a sale on inventory that's sitting there and it's not turning over in enough time for you. So what does it mean and why is it important? It is the number of times your inventory turns over during a certain period. Simply how many days does it take to sell your product, right? A slow inventory turnover can indicate over purchasing, decreased sales, or rapid production, right? Those are not all bad things, right? Rapid production, if you have rapid production, then that's an indicator that, okay, hey, I need to move some money over, I need to slow down, or I need to reduce the amount of hours that my staff is producing this product, and I need to take some of that money and put it into marketing so that I can get my products out there as fast as they're making it, right? Because you don't want to have too much inventory sitting there. It's literally money wasted. And then you have to evaluate your inventory every so often. That means you're going to have to write it down. That means that you're not going to be able to expense it for the same amount that you paid for it, right? And that's time value of money. Money today is not the same as money tomorrow. That's why cash flow is so important. And again, cash flow. And you calculate it by your cost of goods sold over your average inventory. Average inventory is, BI is beginning inventory plus EI is your ending inventory, and you divide that by 2. And that equals the number of times turned over in a year, then 365 divided by that number. So for example, $50,000 of cost, average inventory is 7,000, you have 7.14. That means that within a year, your inventory turns over 7.14 times, right? And then 365 divided by 7.14, 51.2 days. You have your inventory on hand for 51.2 days. Now let me try to make this clearer. Apple has 2 days of inventory. 2 days. If they do not produce another item, they will run out of inventory in 2 days. Why? They're not spending the money, the time, or the labor to produce more products than that. Because the demand for their products, right? This is economics 101, right? Supply and demand. The demand for their products is so high that they can only keep 2 days of inventory, right? That means that their product is flying off the shelf and people are still demanding that product. That keeps them at the top, right? All of this goes, it's a plan. What's your plan? How is everything that you do in your business working to benefit you, right? How is it working to get to that conclusion, right? This is a big part of that. Then you have your quick ratio. It's also known as the asset test ratio. What does it mean? It's a calculation to determine how you can meet your short-term financial liabilities, right? So that's cash flow, right? Do you have enough money or cash equivalents to meet your short-term liabilities? Can you pay your bills, right? And it's calculated cash plus cash equivalents and short-term investments plus your current receivables over current liabilities. Current receivables and current liabilities is anything that's going to convert to cash or convert to due within a year. That's what current means. And so the example is $110,000 divided by 65,000. So this is 110 and it's 1.7. So you have $1.70 for every dollar of liabilities that you owe. So that means that you're 70 cents over what you owe. That's good. That's not bad. Then you have your receivables and your payables turnover. This is something that, even if you think that everything else that I said doesn't apply to your business, your receivables and your turnover is very important, right? Receivables turnover. How effectively are you managing your accounts on credit? Can you collect money, right? How much bad debt allowance are you putting aside? How much are you writing off, right? Can you collect this money? Are you doing, this is an internal process, right? Are you vetting your customers enough that you're extending these terms, and what kind of guarantees are you getting that that money is coming back to you, that you're going to receive that money after you give them that product or you give them that service? Can you quantify that, right? That's your receivables turnover. Your payables turnover is how effectively you manage your debt, right? How often are you paying your bills? So I'm going to go back to receivables too. So for instance, your payables, you're on credit terms, right? Optimally, you should be on credit terms with most, if not all of your vendors, right? You should be on at a minimum of 30-day terms, net 30. That gives you 30 days of cash flow to use to make a sale to pay that bill. So basically what you've done is you've earned money on a product or service that you've gotten from your vendor without paying them first, right? Which is exactly the opposite of receivables, right? So, this is the exact opposite of receivables. So basically, if you have net 30 terms, let's say that you have net 30 terms and you're paying your bills every week, you have a 7-day turnaround. Why? Why have you removed 23 days of free-flowing cash to pay your bills in 7 days, right? We sometimes, when we get, when we move from our personal lives to small businesses, we think about it like, okay, I have to pay my bills, I have to pay my bills, I have to pay my bills. But that's not how it works in business. Business, you want to stretch your dollar. You want to use other people's money to make you money, right? So your receivables turnover is your net credit sales over your average accounts receivable. Accounts receivable is your beginning receivables plus your ending receivables divided by 2. That's your average. And so for $800,000 net credit sales, that's credit sales, not a sales receipt. So the difference between an invoice, and a sales receipt is that an invoice has terms that you pay in the future. A sales receipt is an exchange of money and product or service immediately. So the invoice would be your credit sales. $800,000 divided by $68,000 is 11.76. And then that means that you're turning over your receivables 11 3/4 times per year, right? And so it's saying that it's 31.3 days that you have outstanding receivables. That's not bad, because if you have net 30 terms, people are paying an average of a day late, right? How can you work on that? Is there something else that you can do? Can you send out reminder emails? This comes back to internal processes. How do I affect this number? What does this mean to my day-to-day business? What can I use this calculation for that makes sense to my business? Okay, well, they're paying a day late. Maybe we can send a reminder sooner rather than later. Let's change that and see what that does, right? Because if all of our customers or clients are on net 30 terms, I want them at a minimum to be paying in 30 days. I don't want them to go over that. That affects cash flow. 1 day of cash flow for a business could be a huge, huge impact, right? And then your payables turnover is total supplier purchases over your average accounts payable. And so that's 120 million divided by 40 million. You're turning over your payables 3 times a year, and that means that your payables are outstanding 121 and a half plus days. So basically think about it like this. If you're on net 90 terms with your vendors, net 120 terms with your vendor, you're not doing too bad. You're paying it about a day or so late. that doesn't affect you so much as it affects the vendor, right? It would be on the vendor to take action on that. But if you were on net 120 terms and you were paying in 90 days, you've just reduced 30 days of free cash flow, right? You don't want to pay before it is due. But you also have to make sure that you have the cash to do that, right? And then your net profit percentage. So what percentage of your sales are you retaining in the company? How much money you have after paying all bills in a period? And your annual net profit percentage will tell you how much money you have left to grow, invest, and stabilize, right? So if you shoot for 25 to 30% net profit, that's how you begin to plan your growth. How much of this net profit am I going to use to grow the company? And then you go into the calculations of how much are you going to grow the company, what the projections are for that anticipated revenue, the additional expenses that's going to go into it. Your net profit percentage will help you to get there. And the simple calculation is net profit divided by net sales times 100. 32,500 divided by 960,000 times 100, 3.4% ratio. So basically, you're selling you made $960,000 in sales. You kept, after paying all of your bills, 32%, 32,000, okay? So that's 3%. That doesn't leave you a lot of room to grow, because how do you account for your slow periods? You have to make sure that you have, what do they call it, a rainy day fund, right? We have savings account, it's a rainy day fund. Well, they tell you have 6 months of living expenses put away in case anything happens. Same thing for your business. How do you adjust for the slow period? Well, we took a percentage of our high period net profit and we put it to the side to cover something to that effect. As you grow in your business and you begin to stabilize more, and free flowing cash is not an issue for you, you're going to want to look into low risk investments for that money, right? Because you don't want it to just sit there in what is the savings rate now? It's extremely low. You don't want it to sit there and do nothing. You want your money to make money. If I have the discipline to save my money, I want it to make some money. If you're going to lend my money out, pay me something. And that is all for the slide presentation. I'm going to have to add these other items into the presentation, but I wanted to go over a couple of them. I think we already did, but I just want to hit them really quickly. So your cash flow is your free flowing cash. How much money do you have at the end of every period to cover your expenses, right? How much money is coming in? How much money is going out? What's left over, right? What's a good number or percentage to be at for your cash flow? If you're a small business and you're not making a lot of money, you're going to be just paying everything out. You're going to try to hit break even. But if you're beyond that point, you want to have at least 3 months of payables available in cash so that you can pay your bills for a 3-month stretch. And then your income statement, we talked about this. I call this the essay, right? The intro, the body, the conclusion. The body is going to populate the conclusion. The body is where Millennial operates. We hit there because we come into your business and we help you with your processes, with your internal controls, so that you can get this right, so that we can focus on if you're going to change your product or your service, or if you're going to grow it, how are you going to do it, right? We focus here. And then the accounting equation, assets minus liabilities equals equity. Your balance sheet, your assets, your current assets and your long-term assets. Like I said before, your current assets is anything that's going to turn to liquid cash within a year. Your long-term assets is anything that's going to turn to liquid cash in over a year. Your liabilities, again, current and long-term. Current liabilities is anything that's going to become due within a year. Long-term is beyond a year, right? So if you have a mortgage, your mortgage is a long-term liability. And equity is retained earnings. That comes from your net profit or net loss, right? Every year, when you calculate this, This is closed out to your retained earnings. That tells you how much money from the operation of your business have you kept and now you own, right? And it doesn't mean that this amount of money is in the bank. It doesn't mean that that's what's in the bank. What's in your bank account is your cash flow. It doesn't tell you if you made a net profit or net loss. You could have lots of money in your bank account and have a net loss. Do not go by your bank statement. That is not telling you if you have a net profit or loss. That you will make a mistake. So, thank you for your time. Questions, comments, concerns? I'm here.
A lot of turns when.
Uh-oh, come on, ask.
Yeah, right.
So,
Give me one.
I think the easiest one is, this is obviously not, unless you're like, this is your spot, right? Like, you'd understand this. If you're the small business owner, what is a step one?
Step one is to hire a bookkeeper or an accountant. And when I say hire a bookkeeper or an accountant, there's a big difference. A bookkeeper generally, probably in past times, was data entry. But you want somebody to analyze your data. You want somebody that's going to go in there, that's going to get your chart of accounts set up the way that you need it so that you can read it. All the information from your business is going to be published in your financial statements, and you want that information to be useful to you. The only way that it can be useful to you is that if it's set up properly. You have to hire somebody that has the knowledge and experience that can set that up for you. And of course, this comes off as a foreign language to business owners because you are great at you're great at making the sale, right? You know your product, you know your service, you know how to market it, you know how to get it done. That's what you do. That's why you created your business. That's your passion. Your introduction is your passion. You have to hire people to get the rest of this right. Right? And if you don't have the money to do that, then what you can do is I teach QuickBooks at NCTC, right? You can come see me and I give an intro to accounting and I teach you how to use QuickBooks software, right? I hope I didn't confuse you guys too much, but yes.
okay, the way I see it is that if you have a product, you sell the product, and you figure out how much money you're gonna make off of each product that you sell.
Mm-hmm.
So the main thing that I took out of that was your turnover of product. How long did it take you to go ahead and sell? And then I guess each product, or if you got a whole range of products. So then you said, if you're not selling it fast enough,
Mm-hmm.
you need to do marketing. What's the average amount of money that you should spend of your gross sales to put into marketing, would you suggest?
I see where you're going with that.
Okay.
How did you figure out that?
Well, it actually totally depends on your business model and what you do, right?
Right.
So if you're talking about the production, rapid production, is that what you're, that's
No,
what
I'm
you're referring
talking
to?
about sales. If I'm selling swimming pools and I sell them for $30,000,
Mhm.
what I do is after I put in just all of the cost, I realize every time I sell a swimming pool, I make $10,000.
Okay.
Now, how long does it take me to sell it? I want to sell it as fast as possible. So the big thing to me would be, how long does it take me to go through to the cycle? If it takes me 6 months to make $30,000, that's not profitable. Now,
Okay.
if I can do that, every month, that's what I should be aiming for.
Okay.
So I guess since I'm in advertising, that's why I'm asking this, is how much of my marketing, the $30,000 profit I'm expecting or the whole thing, should I be putting towards marketing my swimming pool products?
So generally, and you would probably be you're probably better at knowing this because you're in the marketing arena. But for most new businesses, marketing should be your biggest expense outside of payroll. So that's where you need to focus. How do I get my product in front of my clients? How do I do that? And you have to enlist marketing help so that you can do that. and you need to spend a significant amount of money so that eventually over time it's going to pay you back. Now, how much time? That's something that would be determined looking at your business model, right? How much are you selling it for? How much does it cost you to make, okay, I'm spending this much in marketing. So every time I sell, how much of my market, like for every dollar I spend in marketing, how much do I make for selling my product, right? So okay, let me give you an example. So for accounting, and this is an example to sample. If I do a networking event, right? So if I do a vendor's event and I pay $150 for that table, I also pay for my marketing materials. Let's say I spend another $500. So I spent $650 to attend that event, right? And this is going to get real. I'm gonna leave it out so that you guys won't get confused, right? So because I'm allocating my labor costs, right? So I'm taking time away from doing work by being at this event, right? So let's just call it $650 I paid to go to this vendor's event. If I get 3 clients at my most popular service, I've more than doubled what I spent. That's good. $2 for I made $2 for every dollar that I spent in marketing. So that's how you would think about it, but people generally spend 20 to 25%. That's how I understand it.
Great, thank you.
Any other questions? Can I offer any additional clarity?
You have a
Appreciate the
Yeah.
overview. Appreciate it.
A lot of that stuff, yeah, you're exactly right. Some of us don't need to know all those details, we just need to know somebody that does. But I appreciate the overview.
Okay.
Do you have a preferred platform, or like QuickBooks or
Yes.
Sage or?
QuickBooks is my preferred platform. Oh, let me give you guys something that you can use and that does make sense. Efficiency apps. So what can you use in your business to automate it, right? Are you guys familiar with MileIQ to take care of your mileage? Okay, and then there's an app called Receipt Bank. And you can take pictures of your receipts, it'll scan it and pre-populate everything for you, and you can publish it right into your accounting system. There's no data entry. And basically what that does is you can throw your receipts. Once you take the picture and throw that away. No more shoe boxes, garbage bags of receipts or anything like that. And then HubDoc,
What was the
Receipt Bank.
Receipt Bank?
And then HubDoc is another platform. They also do receipts, but it is best used for invoices. So when I talked about vendors, you can pull from that account directly your invoices. They'll fill it in for you, they'll scan it and fill the information in for you, and you can set it to automatically publish to your accounting system. You never have to touch it. You never have to get your email box bombarded with invoices, and then you have to manually enter that into your accounting system. They can email it directly to your HubDoc. HubDoc will scan it and populate the information, and if you set it to automatically publish to your accounting software, that's what it will do, and you don't have to touch it. So these are apps that help you with. My firm believes in source data. If I can control your source data, I can control the automation of data entry, and I can get you a pretty basic financial statement without any adjusting entries. So at all times, you would know what your financials look like because I've controlled the source data. We get that in there, it's automated, you don't have to touch it, you don't have to hire somebody to touch it, and it's done.
What do you think about the QuickBooks Self-Employed?
Don't use it.
Why?
You're pretty much just putting your bank statement in there. You cannot create any accounts, no chart of accounts or anything like that. You're just pretty much allocating business expense, personal expense, business expense, personal expense, and that's it. So there's really no clarity into what you're doing. I would suggest to everybody to use the Plus subscription, only because it has everything, because you never know what you're going to need in the course of business. But if you start off at the smallest and you find that you need to access something or you need to do something and you don't have it, then you have to change your entire system. You have to do it
It is
all over
literally
again.
completely not compatible with the rest of QuickBooks. So the moment you try to go from self-employed
Right.
to like the Plus or Essentials or whichever other one you wanna use,
Mhm.
there's nothing. You might as well have gone from QuickBooks to Sage. Nothing turns over and it doesn't give you any data.
So I'm using it because I'm a service, so my expenses are, I don't have that whole chart thing, it's.
You do.
Well, but I should. So I get, luckily I don't have inventory and cost of goods sold and all those
Okay.
things. So I am using it just as, so basically at the end of the year, it's all tracked, it's a
Okay.
spreadsheet. But I definitely get what you're saying as far as, yeah, I can't pull reports out of it,
Okay.
so, but I appreciate that's.
Ooh, a little warm. So accounting should be your book, right? This is your information. This is your business. And I know I've gone over a lot of terminology that may have gone over, and maybe in a future time I can talk to you more like the man in the street. That's what my accounting professor used to say. If you can explain it to the man in the street, then you got it, right? I hope I didn't do you guys too much of an injustice. But your accounting reads as your book. And it's not, you don't do accounting just for tax purposes, right? A lot of businesses, that's what they focus on. I just need to get my taxes done. No, you don't. You need to continue doing business. And you need to figure out, you need to be able to see what's gonna help you to continue doing businesses. That's what accounting does. That's your book. That's what it gives you clarity into.
All right, well, thank you.
Thank you.
Thank you.